Hey, this is Josh Misk, Vice President of Investments with Invisor. This is our June 2016 market update. In this update, we're going to focus solely on Britain's decision to leave the European Union this past month. It's the biggest news of the year and probably the biggest news since 2008 in the financial markets. We'll talk about what exactly it is, the market's reaction to the news as it unfolded, and what we think that means to your portfolios going forward. So starting off, what is the Brexit? Well, as we've noted in the past, Britain is a member of the European Union. With that, they have the benefit of the free trade agreements within the Eurozone. They are allowed to piggyback on Europe's free trade agreements with other nations or other trade agreements that they have. There's the free movement of people across the Eurozone. But with it, they also have to contribute to the European budget and abide by European regulation. Now, where the Brexit stemmed from was frustration amongst a smaller group of individuals with having to abide by all that regulation, all the red tape that they saw in getting things done. As that started to pick up steam, other political causes kind of joined onto there with people that also wanted to limit immigration and so on and so forth. And I think it did get a lot bigger than people expected it to. What we'll do is we'll take a look at the Canadian 10-year bond over the course of June and the yields. I think it paints a pretty clear picture as to how the market digested the Brexit vote in particular. Now, the vote took place on June 23rd, and it was a shaky first half of the month as the market braced for the uncertainty of a vote one way or the other. The flight to safety caused yields to drop, as we see in this chart. But in the days leading up to the vote, there was a strong consensus that the Remains would have it, and that risk-on mentality came back into the market. Bookies were actually putting it at an 8-to-1 chance that the Remains would have it that day, and you can see that again play out in the bond yields as they rise up. But then, on June 23rd at 10 p.m. London time, the results started to disseminate, and it became apparent that the Leaves, in fact, would have it, and the floor was pulled right out from under those bond yields, and they dropped again significantly. The euro and the pound dropped significantly. Global equity markets, they tumbled significantly as well. Trading was actually suspended in two British banks that day. And it wasn't until the third day that we finally saw the market start to stabilize as those fundamentals kept it in check. You know, I think this is a good point to highlight the benefits of diversification in a portfolio. In a time as volatile as we've seen over this past month, where you have global markets fluctuating up and down significantly, it's interesting to look at a well-diversified portfolio and how that reacts in a time like that. So in this chart, we're looking at a Invisor portfolio with a 75% exposure to equities and the remainder exposure to fixed income. By spreading out our holdings across several markets and rebalancing between them, we can offset a lot of the downside risk that we have in any particular market and maintain our exposure to the upside potential. And you see that portrayed perfectly here. Now, going forward, we'll expect heightened levels of volatility as Britain and Europe come to an agreement on a new trade arrangement between the two economies. And unless Britain can lock down something solid soon, they're going to continue to have to contend with contracts being lost, with jobs moving over to the European mainland, with a potential referendum in Scotland, and potentially a more restrictive border between Northern Ireland and the Republic of Ireland. Now, what they'll be looking for in a new trade agreement is to have the free flow of goods between Britain and the EU without having to give up other concessions like abiding by EU regulation. Now, the European Union has an incentive to levy stiffer penalties on Britain for leaving, as they don't want to incentivize any of the existing members to see that as a viable option. So this whole process is leaving the global economy pretty uncertain. It should take about 2 years or so to wrap up, although I think it's in everybody's best interest that it wraps up sooner than later. And although the global economy will have to deal with this uncertainty, the global economic news over the past quarter has continued to remain pretty solid. Manufacturing activity is up, U.S. home sales are up, and job growth is still positive, although it's slowing. Events like this will continue to shake the foundation of the global economy, but as we saw in June, market fundamentals will hold out as investors take advantage of those mispricings and of that overreaction. And I think what June does in particular for us is it helps paint the picture as to how important it is not to pull the trigger in these knee-jerk reaction type of situations. Selling when there's negative news, sending the market lower, only to buy back in again when it's on its way up. It's much more efficient from a long-term performance perspective to stay invested, to be patient and be calm during times like this than it is to spin the tires and try and time the market. And when we think about things from a long-term perspective, when we take that 20,000 feet view of the economy, we're still in this risk-off mentality where there's a lot of cash on the sidelines. And as we've said in the past, you want to be invested when this money finds its way back into the market. So our message for long-term investors remains the same. Stay invested, stick to your plan, and keep a well-diversified portfolio. It's really going to help you in months like June where the market is very, very volatile. That's our market update for June 2016. Thanks for watching, and we'll see you next month.